So for me, it depends on your time horizon. I mean, I don't look at it in year to year gains. You look at it full cycle gains. Full cycle for me is the business cycle. So it's not necessarily the 4 year, Bitcoin cycle. So you look at the gains over the cycle, and over time they compound. So here we've had a year which has been pretty lackluster. It's gone nowhere at Bitcoin level. But at Bitcoin level means that everything below that has underperformed. And I get it. It feels terrible.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
Raoul Pal breaks down crypto cycles and smart trading moves, and we'll unpack key insights together. Stick around to discover the strategy.
It's exactly what the ISM is telling us. The ISM survey has been below 50 the entire cycle. It's the lowest, it's the longest period of below 50 ISM. So that's no real economic expansion in history now. And so that is exactly the K-shaped recovery, because what we've got is this massive capex boom going on in the hyperscalers and the AI space, some government spending, and then other than that, the economy is pretty flat. So you're seeing it everywhere. You know it from everywhere. It's one of the reasons why retail haven't come in crypto, because they don't have any disposable income. Real wages are still pretty low. Economic activity for most businesses is not great. And this is the thing that Scott Bessent's been talking about, is how do you increase Main Street activity? And that is what has to happen. That's the rate cuts. That's taking taxes away, not paying taxes on tips and things that run the basic services and the basic economy of what most people live in. So, I think the read of, Chipotle or whatever is dead right. And that is what I think the Trump administration will focus on to try and get the midterms through. And I think they really understand this game. I never liked the DATs to start with, because a lot of the incentives are not aligned. So really it allowed people to get exit liquidity on positions that were locked up and stuff like that. So that I didn't like. Over financialized structures always make me nervous. These look like closed-end funds and they can trade at discounts for whole periods of time. But then you got this issue with, they sell the underlying to buy back the shares. And we're starting to see that. And I think, that can continue in a down market. I think these things trade like perps premiums or futures premiums. So they have negative funding over extended periods of time when the market's like this. And the dynamics are not great. So, if we love the run up because of the DATs we're buying, you're going to love the rundown as they're selling. It's a bit of a mess. And I'm surprised the market allowed this to happen. But how they allowed it to happen was not a great way either, because these things were bought by hedge funds. They bought the pipe, and they just they'll take a 5% turn.
Strategy's unexpected mention of a $25,000 Bitcoin scenario has stirred up a wave of curiosity and concern across the crypto community. The company, formerly known as MicroStrategy, posted on X to highlight that its Bitcoin reserves still provide strong coverage over its convertible debt, even if BTC were to plunge to $74,000, or, in an extreme case, $25,000. While the message was intended to reassure investors, many found themselves questioning why such a dramatic price point was even part of the conversation. With Bitcoin currently trading around $87,567, the jump to discussing a $25,000 scenario felt abrupt and unsettling to some observers. Yet the situation may not be as alarming as it appears. Bitcoin's recent dip below $81,000 put Strategy close to its average purchase price, which drew attention from critics like short seller Jim Chanos. Despite the pressure, the company maintains a substantial buffer. Its Bitcoin holdings far exceed its debt obligations, giving it room to endure volatility without rushing into liquidation. The long-dated nature of much of its debt also provides breathing room during turbulent market swings. Combined with additional assets and steady business cash flow, Strategy remains positioned to weather downturns without relying solely on its BTC stack.
In a month, walk away. It's a 60% annualized return. They don't care. But what then? You dump it, and then there's no buyers of this stuff. So then they go to a discount, and then these people are then forced sellers. So it's a mess. Should never have happened.
Yeah. You're wrapping a liquid asset into a equities. It's still an illiquid asset, and it dries up really quickly.
Yeah, I mean, some of these will end up doing well if they manage to become ecosystem investment funds that can capture forward value. But selling shares to buy more of the underlying cannot just be an entire business model. I've been lucky enough most of the way through. I mean, I haven't been in Bitcoin all cycle. I've managed to outperform it via just having the right asset allocation. Yeah, bought Solana at the lows and then switched into Sui when it had its run. And it's given a bit back. But generally, that's worked fine. I'm not a big fan of going too far out the risk curve. I have this whole don't fuck this up thesis. And a lot of it is every time you think you're really being smart out the risk curve, your probability of success is pretty small. So I tend to stick with layer ones generally because it's definable. I understand the metrics, I understand what drives them. And then, if I look at my wallet of shame from when I've allowed myself to FOMO in on stuff. I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone. If I look at it, every single trade I did lost money.
What's been your worst trade?
I think I've lost near 100% in smoking chicken fish, which was like one of the memes that I held, and I had a reasonable sized position in it. And I thought, I can't get out of it because it's just going to nuke the market anyway. So I wrote it up, wrote it down. But, I treat it like a call option. I knew it was the highest probability chance it was going to be a zero. But, you also don't really understand markets until you participate in the elements of it. Yes. You need to get a feel for what it's about to understand what memes are about, how DeFi works, that kind of stuff. So to have a bit of capital that you're going to nuke to learn is a very good thing to do. Yeah, I'm more risk-seeking. I'm pretty much 100% crypto, and I'm comfortable with that. And I've been that way for years and years and years and years. So I don't really worry about that. But generally speaking, the portfolio has been split between crypto and tech since December 2022. So we managed to get most of the lows or around the kind of lows period and have held those positions through and through, adding in stuff like solar and a few other themes within it. And because I'm a business cycle investor, that's how I think about it. I won't really change that until I see the business cycle peaking out. And that's generally how it's worked for me over time, is extending your time horizon actually increases your returns, as opposed to, worrying about the next 3 months, 6 months, unless you're hitting a cycle peak or top or bottom.
Bitcoin is heading for another red month, breaking its usual pattern of strong late-year performance, and traders are starting to wonder what comes next. November is typically Bitcoin's best month, boasting average gains above 40%, yet this year it's slipping more than 20% from where it started the month. This follows an already disappointing October, which also went against its historically bullish trend. With Bitcoin now trading around $87,305, BitFinex analysts say the familiar seasonal tailwinds just aren't kicking in like they used to. Still, the story isn't entirely bearish. Whale activity, often a major driver of momentum, is beginning to creep back up. Sentiment recently reported more large wallets accumulating again, hinting that bigger players may be preparing for a potential rebound. At the same time, analysts have noticed Bitcoin dipping below the cost basis of short-term holders, something that has only happened a few times this year. Many buyers who jumped in above $106,000 are now selling at a loss, adding pressure to the market. Bitfinex believes the market now sits at a crossroads. Either demand returns in a meaningful way soon, or Bitcoin drifts into a longer, deeper accumulation phase. Even if seasonality fails to repeat, December has historically been calmer, leaving traders watching closely for the next spark. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoinzilla. for daily news, all for free. That's all for today's video. Until next time.